Hi, I'm Gene Trowbridge of the law firm Trowbridge Nieh. We're lawyers that work in the area of the private placement market, syndication, real estate, and other type of businesses. And I'm happy to share this YouTube video with you. If you ever have any questions, you can just call us at the number that's on the screen. That's our general switchboard number. You can see our website. We have all sorts of good things at our website. If you go to our website address, which is tnllp.com, and of course, go to our YouTube channel, and you'll see the YouTube that I put together on this topic. What is the size of the private placement market, and what's coming next? So, Gene Trowbridge, this is me, and I'm the founding partner of Trowbridge Nieh. You can see that I've been in the business a while. I was a syndicator, always been a real estate broker, senior CCIM instructor for 40 years. I went to law school at 45 when I left the business of being a full-time syndicator. And now for the last 30 years, what I've been working on is I've been working on clients who are in the private placement business. And I have a book out called It's a Whole New Business, and I'll show you how you can get a free PDF of that book at the end of this video. And I'm an old runner. I run half marathons. I started when I was 60. And I guess at the time I'm recording this, I've run 36 half marathons since then. So let's get right into it. How big is the private placement market and what's next? Well, here's why we're in the private placement market. This is my picture of the structure of a syndication that will fit in the private placement market. And the first thing what we have is we have an LLC that's called Investment LLC. And this LLC is formed to own a property or for a blind pool of a number of properties. And then we have to have investors. So these are called members. They purchase interest in Investment LLC by investing their money, and they're expecting to get cash flow out of the LLC from operations and the sale when the property is disposed of. Because there's a number of investors in here, we have a manager. The manager is a member of the LLC or a non-member of the LLC, but the manager makes the decisions. We might have some enhancers who bring their financial statement or bring some money to the table for compensating balances. But that's the picture of the structure of what we're talking about. And why it's important is when a group of investors invest their money in a common enterprise for an expectation of profit, but everything is run by the manager. The profit is going to be determined by the efforts of the manager. You have just seen the definition of a security, an investment of money in a common enterprise with an expectation of profit through the results of the manager. And so now we're in the securities world, and the rule is that every security has to be registered with the SEC unless it's exempt. And if it's exempt, we can move it into the private placement market. And so here's kind of a flow chart. First of all, we decide if the structure we've formed is a security, and if it's manager managed, it is. So now we're in the securities world. Remember, I said every security needs to be registered with the SEC, full-blown registration, unless it's exempt. And the biggest place for exemptions, as you're going to find out, is Regulation D. There are also things like Regulation A and Regulation Crowdfunding, Regulation CF. Now, the SEC has just printed this year's version of their what's called their report from the Advocate for Small Business Capital Formation. Quite a name, right? But what this SEC office does is they advocate for the ability for people to raise money so they can start their businesses. The SEC believes that 99% of all the businesses in our country qualify as small businesses with less than 500 employees. So there are a lot of things that people need money for. Every time you start a business, you probably need to either go to the bank or family and friends or relatives or your own business or other people to raise money. So their report that just came out in December tells me what the size of the business is. And it's pretty darn exciting. In Regulation D, the place where your offerings are exempt, as I said, this is the biggest chunk of it. In 2023, the report said that there are $2.9 trillion raised in that market. That's a big market. 506B, which is one of the choices under Regulation D, has 2.7 trillion, and 506C has 169 billion. Now, you might be surprised at that because some of you think that Regulations 506C is growing in stature. Actually, 506C went down in 2003, where 506B and the total amount of money raised went up. Now, my slide always also tells you the median of each offering. In 506B, half of the offerings were above 1.2 million and half were below. So we don't have to raise $100 million to start our business or buy some real estate. In 506C, the median was even smaller, just $750,000. Now, as you might know from other things you've read, the difference between a B and a C typically is that in a C, you can advertise for people to invest with you who don't know you. Well, if that was going to be such a great thing, 506C would have much more money raised. But it's difficult to get people who don't know you to respond to an advertisement and just send you a check. So 506B is where you're investing, or your investors are people who know you, have a pre-existing relationship with you. There are other offerings that are exempt from registration, but you'll see that they don't raise too much money. A Regulation A plus, $1.5 billion, and the median is 1.6 million. Half of the offerings are lower than that. And Regulation A plus is kind of interesting because you can advertise and you can take non-accredited investors and accredited investors. It's expensive, it's time consuming, and it doesn't seem like it's the heart of the marketplace, does it? Regulation crowdfunding, 352 million, the smallest of all the exempted offerings, with a median of 100,000 and only 919 offerings in the last year, where 506B had 17,000 offerings. So typically you're going to be in 506B. That's where you're going to be. Now, the top states in Reg D offerings in excess of $20 billion in the state are listed there. You'll see California was number one. California had 4,902 offerings under Regulation D. And then the last state that raised over 20 billion was Illinois. So you can see the list of states where probably our firm gets most of their clients, because this is where people are forming their LLCs and doing their offerings. The top industries in Reg D offerings are real estate, banking, technology, and healthcare. Now, one of the things we have to understand in this $2.7 trillion that's raised in 506B, many of the offerings are not real estate. And most of the offerings and most of the money is raised by the broker-dealer community. The broker-dealer community of people that have securities licenses, they have databases of investors with whom they have a relationship. Rarely will you find them advertised. They are going to raise money from people that they know, their financial planning clientele and other people. So that's really where the money comes from. Our part of the world, where we do real estate syndication, is a small part of the world. But, our firm doesn't do just real estate syndication. Last year, We helped put together a group that bought a minor league professional hockey team. We put together a group that is out there in the business of making short-term loans to businesses, merchant advances, it's called. We put together a group that started a fiber optics company to hook up apartment buildings to fiber optics so that the tenants in the apartment buildings can get high-speed internet right from the building. So there are a lot of things that we do. Jonathan in Regulation Crowdfunding has helped people do whiskey and sake and things like that. So a lot of things we do other than just real estate. Well, so it's a big market. I guess I should say that 2.7 trillion, according to the SEC, is more money than was raised in the public market during the same period of time. So this is where the money is raised in the United States. And so the question is, that marketplace keeps growing. Well, what's next? Well, at the same time that report came out, another report came out from the SEC. Both of these are now from the SEC. And in 2008, Dodd-Frank required the SEC to every 4 years do a review of the accredited investor definition. And if you remember at that time, the biggest thing that happened is the SEC suggested and Congress approved that the equity you had in your home could not be used to help you calculate for the $1 million level of being an accredited investor. They thought that people shouldn't risk that money. And that's important to remember for when I get to the end here. So every 4 years they do this. Last 4 years, they came out with some proposal that let securities licensees be accredited, increase the definition of a family to someone who's living with a spousal equivalent. That was big. Change the definition of entities to $5 million of assets that could be accredited just as an entity level. Actually, from Dodd-Frank to the Jobs Act to 2022, what's been happening is the SEC has been improving the arena and method for capital formation. Now, as we had every 4 years since then, there's going to be a discussion, and it's going on because the SEC has issued this review. It's not a proposal. It's nothing like this. It's just a review, and it's interesting to read. What they're telling us here, and I just grabbed some bullet points, is right now, 18.5% of all the households in the United States are accredited. And when Reg D was passed in 1982, with the $1 million net worth, $2 million of individual income, there were only 1.8 households that were deemed accredited. Now, one of the arguments that the SEC is saying now that 18.5% of households who are accredited who don't need the protection of the government is too many, too risky for people. So they've looked at a couple of things, and one of the things in this proposal was, well, in 1981, $1 million was a lot of money. Let's apply inflation to that $1 million until 2023. And in that case, the $1 million would grow to $3 million. So if they applied inflation for the whole period of time, the definition of an accredited investor would start with the $3 million net worth, still not including your house. And then the $200,000, which was for an individual, would have grown to $600,000. And $300,000, which was really something that was added later. It didn't appear in the first bill. It was added later from people married, filing jointly, so you could combine a husband and a wife's income. That level was set at $300,000, and now that would be 900,000. So if nothing changed and inflation kept going the way it was, the SEC projects that by 2032, in 10 years, 30% of the households in the United States would be accredited. And that, in their feeling, is too many. So from the report, and the report is like 50 pages long, really there are three things that they could suggest. And they're asking for comments. If you go to that website and read the report, you'll find out how you can send a comment in. Now, once again, there's no proposal. It's just a report. How these things work, they have the report, they wait for comments, and then they make a preliminary proposal. The preliminary proposal comes out and is valid for 60 or 90 days, waiting for full-term responses from the public. They take that into consideration, and then they issue the regulations. So if anything is going to change, it's going to be a while. But here are the suggestions that the report has. First of all, let's start inflation, the inflation adjustment, back to 1982. If we started it today, 6.5% of the households in the United States would be accredited. Well, that's less than 18.5, but more than 1.8. And, assets have gone up in value. There still would be a number of households that are accredited. The next proposal they had is just to realize that that would be too much of a jolt to money raising. So maybe we should just start inflation now, accounting for inflation every 4 years, make an inflation adjustment. That might be okay. They didn't have any projections on how that would work if they did that inflation adjustment in the future, but it certainly would start reducing the number of accredited households. And the last thing, which I found very interesting, remember I said that in Dodd-Frank, one of the adjustments they made to this 2008 to the definition of accredited investor is they took out the equity in your home in the calculation of the $1 million. They wanted you to be protected against losing that equity. Well, now in this report, they have quite a discussion about retirement income, retirement accounts. And one of the projections they say, one of the suggestions they say is that if we eliminated retirement accounts from the calculation of net worth, the number of households today that would be considered accredited would drop to 18.8%, roughly half of what it is. So I don't know if either of these three suggestions are exclusive. They could conceivably eliminate the retirement income from the $1 million net worth, and they could start inflation in 1982 on the individual income approach or the married filing jointly income approach, or they could just start to put inflation in against those two numbers as they go on. So no one knows exactly what's going to happen, but this is a huge marketplace. And what's so very interesting is the first report we looked at was the report of the SEC's Committee on how to promote capital formation. The second report we're looking at is how the SEC, one part of the SEC, is concerned that too many people are accredited. Well, if you limit the number of accredited investors, you're going to limit the amount of money that can be raised. Because the rule is in 506B, 35 sophisticated investors and an unlimited number of accredited. Well, if you cut the number of accredited investors in half, you're probably going to have more difficulty raising the same amount of money. So at the same time, the SEC over here is interested in eliminating a number of households from being accredited, the SEC advocate for capital formation is saying you can't do anything like that. Anything you do to change the accredited definition accredited investor definition, will minimize the ability of people to raise money. And money is important because what does money do? It funds businesses. And what do businesses do? They employ people. So any change would create less money going into those businesses with 500 or less employees and potentially limit the amount of employment in the country. So it's a catch-22. The SEC has two parts that are arguing over this, and we'll see what happens during 2024. So I mentioned earlier that I have a book. We're now in the 4th edition of my book, It's a Whole New Business, and you can get a PDF of this book free by clicking on the QR code, and we'll send you a free PDF copy. And in the book, we cover all the things on the left-hand side of the slide: fiduciary duty, risk, rewards, entity structures, securities laws. Everything that's there is in a separate chapter. We also have a narrated version of the book on Kindle. You can go to Kindle and research It's a Whole New Business and hear me narrate my book if you're interested. And of course, the book's available on Amazon if you want a hard copy. So that's what we have. I think that's a good book, 4th edition. It's right up to speed on all the current laws. And so once again, this is Gene Trowbridge with Trowbridge Nieh. Contact us if you have any questions. Here's our phone number. Here's our website. And there's our YouTube channel. And if you go to the YouTube channel, be sure to subscribe. And I'll talk to you later. Thank you.